Right, so stocks responded today to a second day of some pretty significant headline new risk. This case being a significant geopolitical risk with Russia apparently imminently on the verge of invading Ukraine over the weekend, is what came out today, as most of you probably have heard by now if you're watching this. And the market responded pretty significantly to it. So I'm going to break down. If you recall, the technical environment that we've had already going into this wasn't necessarily, bullish or trend changing back to bullish yet. In fact, it had been a little weak, and we already had started the weakness yesterday with the response to the inflation report. Well, now, the weakness kind of got exacerbated by this rush. We're going to talk about how it fits in the overall technical environment already that we're in, and what that suggests, going forward about expectations for next week and the week after that. So we'll break that down. We'll also talk about our trade idea of a stock that's, had a hard time over the last couple of weeks here to kind of get above water, and looking like today got below water. But the bottom, it's relatively shallow into the pool. So we'll talk about how to trade something that's underwater but doesn't have very far to fall before it hits the floor. So let's go ahead and get started. Today is Friday, February the 11th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. And boy, did we finish down today. So we closed below a bunch of lows from this week and last week, even though we didn't get all the way below last week's low point. We were right at it. That's Monday's low point from last week. We are back below the 38% retracement. Dark pink shading and a red line again. Still obviously 3% or more below the moving average. Short-term sentiment, we talked about in class yesterday that it had already dropped out of the upper reversal zone without getting up, just kind of dipping its toe up there, and then already dropping out of the reversal zone, and then now today getting out of bullish territory in general. So pretty bearish when you get a near-term peak that's that relatively low, because it didn't get up here like this one, and then is short-lived as it was. Obviously pretty bearish short-term sentiment, not surprising, right? When you look at the Russell 2000, it's back below its 23% retracement. Its intermediate and market sentiment lines are both rising, though they're still in bearish territory. And short-term sentiment did get up to above the 90th percentile and got up to a higher high point there, but now is flirting. Did not finish that far below it, but flirting with getting back below that 23% retracement level. The NASDAQ did get below its 23% retracement level of both the long-term post-COVID rally and this intermediate pullback, or this intermediate pullback that we've been on, right, to the upside. Its intermediate line and market sentiment lines are both either in or just about there, bearish territory, and they're both falling, unlike the Russell 2000. And you can see we are well below, more than 5.5% below the 30-day moving average, and flirting with last week's low points there. Let's take a look at the weekly chart for these. Here, let me go to the weekly chart. For the NASDAQ in particular, you can see its intermediate line on the weekly chart is now in bearish territory there, so pretty significant. Dark pink shading and a red line. Short-term sentiment tried to get out, but it's not really following through with some bullishness, especially after the long upper shadow last week and then the bearish candle this week. The Russell 2000 has been in dark pink shading and a red line for a while. It also ended up with long upper shadow this week, and you can see it's kind of floating with that 23%. Its intermediate line is not only in bearish territory, but it's also in the lower reversal zone, but market sentiment still got a ways to go. And you can see the near-term lines also try to get up, but get up to the top of the chart is unable really to get going. The S&P 500, it just barely got dark pink shading. This is the first week it's got dark pink shading. It still technically doesn't have the red line yet. And its near-term line got a little bit higher, got up into the bullish territory, up to the 60th percentile, 60.22. Its market sentiment line is actually still in the reversal zone. And finally, your Dow Jones, which has been the most bullish, also has dark pink shading. It's crossed below 50th percentile in the intermediate line. Does not have the red line yet. Long upper shadow the last couple of weeks. Near-term line got a little bit higher, right? And so, but still, everything else pretty much looks very similar. Looking at the This chart here, you can see just another transition candle. We've had a big bearish candle. We followed up with a couple transitions. Slightly negative differential this time, but still a falling PPO. You look at the NASDAQ, same thing. It's a negative differential. We are still well below the, still below the red line, still below the green line. In fact, you're almost to a death cross there on this chart of these exponential moving averages that we already have on the Russell. And then you can see just a slight positive differential on the Russell down there, but still a falling PPO and still easily below the 40-week, no green arrow. So we're not threatening any kind of reversal here. And we've been taught, it's been our theme all week, that we're not threatening any kind of bullish reversal here in the least bit. Let's take a look at the 3 green arrow charts. And you can see the MACDs are all still positive. So we don't even have red arrow. We only have one red arrow. We have one on the Qs now, and one just barely on the S&P. But we don't have 3 red arrows because the MACD hasn't turned negative yet, and we don't have 3 red arrows over here. On IWM, we don't have just the 1 red arrow, and we just have the 1 red arrow here on the diamonds too. So, if this is a new leg lower, you can see we're just kind of getting, like, we still don't have the 3 red arrows, which is your, kind of signaling the new leg lower on this chart. When you look at the 2-line versions of all these charts, you can see the S&P broke below the 200-day moving average. So easily back below the 17 and the 8. Flirting with the point of control again. Remember, it will get more bearish if it gets below the 23% line. And back below the 200-day. The Qs, the same thing. It has been below its 200-day. The price got below the 200, the 8 and 17 got below the 200, and now the 30 is flirting with the 200. And you can see we've held the point of control for resistance, and we're easily back down below the 23% line. So a little bit more bearish there on the NASDAQ. Your IWM, you can see back below the 17, though not as bearish. But remember, it was more bearish here, right? It's had a little bit more of a rally here in the past week or two because it was way more bearish going into that. So now it's just flirting with that 23% line, still easily below moving averages. I mean, again, we're in death cross. See, none of the others are in death cross yet. We're in death cross and going there. The diamonds, if you recall, has been more bullish. Today, it got pretty bearish, relatively speaking, right? It's still flirting with that point of control. It's still got to get back below the 23 and especially the 38 and especially the 23. But you can see how the MACD and stochastics are rolling down. And it appears like it may be holding resistance. And this will have some, if you look here, this will have some relative, like really poor margin of safety, because if you break that line, you break below all this volume, there's a big gap here to fill in between the 50 and 200 week moving averages, at least down to that 38% Fibonacci retracement, down to 297. That's about 50 points away here. Whereas IWM, you can see, has already filled in some of that gap. There's still more to go, but you have that 38% retracement a little bit closer to where you're at right now, and then in the worst case scenarios, it gets down to the 50% retracement and fills in that volume gap, and that's kind of my expectation. So you don't have that necessarily here. You can get down there, and there is some gap to volume, and you can hit that 50% on the diamonds. And the Qs, you can see, is even worse, right? It's 200 days well below the 62% retracement. So this has got it doesn't have as big of a volume gap, but from a Fibonacci retracement standpoint, it's a big gap to fill if we are indeed in correction mode. Correction mode defined as filling in this gap between the 50 and the 200-day moving averages. Let's take a look at some of these other oscillators here. So let's start off with the RSI and the CCI. Again, tried to get up in the upper half of the chart, back in the lower half, just like that. The Russell 2000, not so bad. You can see, remember, it was been a little bit more bullish on this pullback. So you're still above 40. You're still up in the upper half of the chart. So you're still relatively good there. But the NASDAQ flipping back down, back below 40, back in the lower half of the chart without really getting the bullish levels. Relatively bearish from that perspective. The DMI, we talked about that negative indicator still being above 25. So you can see not trend changing. The Q is easily above 25. IWM is still below 25. So it hasn't made that jump back up yet. And you can see that it can, right? The ADX is strong. The negative indicator can get back above 25 pretty easy. It doesn't have to get all the way up to 40. You've already got a pretty good peak And you don't have to always you've already dropped below -10, so we don't have to do that again. But even a leg lower, I mean, you can still get divergent lows with a new lower low, even with these forming higher low points. Finally, on the Bollinger Band, well, let's look at the Ichimoku cloud. We talked about how, the bearish trend that ended on the spiders and the diamonds was not the case in the Qs. It still maintains a very strong bearish trend. Not the case in the SB or IWM either. It still also maintains a very strong trend. Well below the cloud, well below the blue line, well below the red line is well below the price. So it's easily on some still very strong trends going on. Let's see, now look at the Bollinger Bands. SPY is back in the outer half, right? So in this case, the lower quartile of the bandwidth. The Qs, the same thing, back in the lower half, outer half of the chart and the lower half of the bandwidth. IWM is still in the middle half of the chart, so it's still kind of not really trending yet, and not back into. So it's as bearish as it was. It was way more bearish going into this rally. It was a little bit more bullish during this rally because it had been so bearish, and now it's been less bearish as we roll back down. And we'll see if that's a one-day phenomenon or, if it will end up leading the next leg lower down like it led the last leg lower. Let's take a look at today's intraday moves. Obviously, coming after the move in Russia, of what's going on there. Here, let's go here. Nope, keep hitting the wrong one. Here. So we filled in that gap from Wednesday pretty easily yesterday. We filled in yesterday's opening gap with the rally, and we're coming down, and you can see, again, getting below last week's low point there. And pretty much closing on the low of last week. So that's why it stalled by the end of the day. The Qs broke below last week's low point. So more bearish from that perspective. Lower high, lower low. Closing below yesterday's low. Closing well below last week's low. The Russell did not even come close to closing below last week's low point. So, well up above last week's low. Just barely today got below last week's high and yesterday's low. So again, you can kind of see the relative strength in the small cap index, at least, so far, right? And we'll see if that continues to be the case going into the rest of this. If this ends up being a new leg lower, the rest of this leg lower. A bigger than average range, that was not the case earlier today, but bigger than average range, bigger than average volumes, not surprising. That's what you get when you are, pricing in war in this case. A more significant war than most because of its impact on economies and commodities and things like that from an investor standpoint. When you look at the let's come to the range of the volume. 151 million is well up here. 12 points is well up here. So that's bringing things back up. And when these lines are rising, that's bullish, right? That's bearish for sentiment here. So that's not necessarily the most bullish thing. When we look at the volatility index, you can see the big jump higher. Like we jumped way back up to 100%. We did not close above 100%. We actually closed back above 95%. But a couple days ago, we were talking about 85% kind of holding for support, how we were kind of grinding into it. And we actually made some trades in our options class that week to take advantage of volatility being at support, and it's had a nice little rally up here. And if you look at it on the two-line versions on the VIX, it had pulled back down below these moving averages. Well, today back up. Yesterday got back up above all of them, and then today solidifying that move back up above all of them. And that's on the daily chart, and of course on the weekly chart you can see back above the 8-week, and the 8 and 17 and 30 are all crossing up above the 200 right now. So we are in a higher volatility regime, not just today, just in general. I also wanted to bring up the MACD is turning up here, so and stochastics is turning up. So we might get a new length of time of rising volatility that's again already at 27. So if we do get a new leg higher on these oscillators, it could be high. We can move up into the 30s, if not low 40s by the time we ultimately get our peak. And at that point, we'll probably end up peaking right around 115, 105, 115%. Solidify the idea that we're in a market sentiment decline. Market sentiment decline being the market sentiment line working into bearish territory, which it's in the 50th, 54th percentile there. it's in the 40th percentile here, so it's almost there on the NASDAQ, and it easily is on the Russell and has been in the lower reversal zone. So we are definitely in a market sentiment decline, in a correction mode, pretty much in correction mode for more. I mean, at least on the Russell, we are in correction mode. In the NASDAQ, we are beginnings of correction. We are in the beginnings of a correction mode because we are, we have solidified this break below the 50. We tried a couple of times to get back above the 50. It didn't hold, and now we're back down below the 50. It's kind of solidifying. So we are in correction mode there. And then you can see the 8 and 17 have crossed the 30. And then SPY is in the very, infant stages of being, it has not even crossed below the 50 yet, at least closed below the 50. And the 8 and 17 are just barely crossing below the 30. But you notice we are still easily below the 17. We broke the 17. We've held the break below the 17. And now this little intermediate decline, which is what you get when you're breaking the 17, this intermediate decline is more than likely, if it breaks to 50, going to turn into an actual correction mode here. So that's my take on what's going on. The expectation is we're in for a new leg lower. Nothing drastic, nothing major. We've been in the bearish. We've had some bearishness, and we're going to get more bearishness. It's not going to be the end of the world. It's not going to be huge declines. You get these. When you're in bearish moves, you get green bars, you get red bars, you get, and they're all generally more than 1%, especially with the VIX where it's at. You're going to end up with more and more 2% declines, and nothing's going to be wrong with that. That's just going to be very, very normal market behavior until we ultimately finish this correction, which generally ends up with a red tag on the 10% run, right? That we still haven't even got. We're only less than 8% below. We almost got the 10% on that last leg on a close-to-close basis, but we're still only 8%. So we still don't have a red tag yet like we do, again, on the Russell, which is in correction mode. It got a 21% tag before this latest bounce up. And then the NASDAQ, which also got a red tag at 15% below and is almost back at those lows again, again being in this kind of infant stages. I guess you could say the S&P is in its fetal stages of a correction where we're going to get a bigger number in that red tag. And that ultimately will lead to a pretty decent sized number in a green tag that comes off of it. So do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you should be either a lot more bullish than I am or a lot more bearish than I am? Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. It's a quick way to get, or Monday. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What stood out to you from today's video? What questions or comments do you have about what I brought up? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, as you're watching here on our blog, check out some of these other things on the right. Click on this icon here that takes you to our Market Outlook live page. If you watch these videos here at Monday, Wednesday, and Friday at 3:30 Eastern Time, we do a live video. I go over all the trades we've done in these market outlooks, see whether we should stay in the ones that I've shown you before, when should we get out of them. We talk about how to manage them. We also put on today's trade idea that you hear at the end of the video. We already put that on today before the market closed during this. So if that interests you, that's where you can find it. If you come over here, you can also find it under Market Outlook. Click on Live Trade Review. You can see our upcoming classes over here on the right. Click on View More to take you to the rest of our calendar. All of our upcoming classes here, as well as recorded classes from over almost 4 years back. If you come over here, click on this heart icon, opens up this tab, hit that like button. Also, if you click on this icon here, this thumbs up, it opens up this tab. Hit that like button again. It really helps us when you do that because it gets our content out to more of our followers, the way their algorithms work. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here by just clicking on this while you're watching right now. Let's see if we can't get that number up to 100 over the weekend here. All right, now let's talk about what's driving this price action, and that's obvious. What's driving the price action over the last couple of days, and big inflation yesterday, and then today being the Russian news, right? And so let's take a look at how things have moved just in the last couple of days. So let's go to 5-minute chart. Obviously, you can see the steady decline, and the Qs down 5%. IWM had been on a pretty decent decline, but is down about half of what little less than half than what the Qs are down. The S&P is down almost 4%. International stocks down, but outpacing U.S. equities. Real estate being down, interestingly enough. But gold and commodities and dollar all up, and long-term bonds is not necessarily positive, but because they were so negative yesterday, but they are way outpacing other asset classes, including corporate debt, high yield corporate debt there, even global bonds doing well. Let's take a look at some of those charts here. Pull up this chart, and let's take a look at how that dollar is doing. So we'll look at the ETF that tracks the dollar index. You can see it's been sideways and kind of trading around this volume node, so no real trending action going on. But today's move getting above some moving averages, the 30, the 17-day, the 8-day, all at the same time. MACD is turning up, stochastics is turning up, so there's an opportunity for some bullishness here on the dollar for the next little bit. Here's what it looks like on this chart. The intermediate line is in bearish territory, but some bullish short-term sentiment right now, and see how that impacts opportunity. Light green shading the yellow line, so we're not hardly like trending yet on this. TLT, remember, was so bearish yesterday, and then popping back up today. So big reversal there. Long lower shadow. We got some clusters here recently. We are closing above yesterday's low point, filling in a lot of yesterday's gap. Short-term sentiment still pretty subdued. The near-term line is barely out of the bearish territory. The intermediate line was actually at extreme lows, right down below the 5th percentile. So it's pretty rare for the intermediate line to get that low, but it goes to show just how bearish bonds are. And then you can see the big jump in gold. Gold really spiking higher. The intermediate line getting in the bullish territory, crossing up above its market sentiment line again, which is just starting to rise. And then again, short-term sentiment looking pretty bullish, getting up to new higher highs. Let's take a look at Bitcoin as a reflection of strong risk appetite. Had really rallied, but we talked about that. Bitcoin, you can see the intermediate line getting in the bullish territory. But we talked about how Bitcoin was getting up towards these moving averages. In this case, the 50-day moving average. Some resistance. We have the death cross right now. We kind of hit the 200 on the intraday basis. If we get back below that 23% retracement, which would also mean getting back below these moving averages, then you just would expect that Bitcoin will be bearish here for a while. Also hitting this 38% Fibonacci retracement line of that long-term rally as a resistance, and looking like it may make a run down towards the 62% retracement, which would be just below 30,000, if not eventually below that, right? If you look at where that line is coming from, it's 17,000. After hitting 30, 17 would be in play if we were to break below that. Really, really important. Well, would be for Bitcoin a very, very important support level. Looking at the weekly chart for this, you can see that we are, again, a little bit of a long upper shadow this week, bearish, right? Sitting right at the 17-week moving average, and we're back below the 8-week. And we still have room to go down to the 200, which is, again, at that $20,000, which makes it likely that if we were to fall down here and really kind of take some risk appetite off the table, that Bitcoin would be hit pretty hard. Again, more of a speculative reflection of speculation, speculative risk demand. ARK Investments is below its 200-week moving average, trying to get back above it and struggling to get back above it. Still below that 23% retracement, still below the 62 of the big rally. And still using this big volume node over the last few years as a resistance, so as well as the value area. Even ARK is, again, not looking very good from a risk. I mean, a very corrective, correction here. And again, you expect, obviously, your higher speculation trades will start their corrections earlier, than the safer ones. As we've been seeing so far, these are in their correction modes. The Bitcoin has been, the Russell has been, the ARK Investments have been, and now it's bleeding more into the NASDAQ 100, and eventually we'll get into the diamonds. And we're just not there yet, but you expect that we will. Eventually you can see we're kind of flirting with that 50-week there on the diamonds, and getting below the Fibonacci retracement there would get you below that, and we would just be starting, like I said, fetal stages of a correction, long-term correction mode going on the diamonds right now. So if I were to look at these major economies, you could probably guess which ones really kind of stand out to you right now. Let's look at the 12 grid. Which ones really stood out with a big move today, and that was Russia. And Russia's been on a steady decline anyway, and really dropping hard. India dropping hard. France really getting hit hard. Germany getting hit hard. So Europe is affected by what's going on in Russia. Italy as well. Again, with the idea of the natural gas and stuff. You can see Korea, again, kind of reflection of global growth demand. Not as bad, though still relatively bearish. You can see China is actually still above its moving average. And then you can see like Brazil is like, hey, we've got commodities here. If you can't get them from Russia, we've got some. So they're benefiting from a little bit of a rotation. And they were so bearish, they've got a lot of room to run to be bullish. And the UK is actually holding up relatively well too, considering the geopolitical environment. Let's take a look at the sector moves and how they performed these last 2 days, right? We've got these last 2 days with risk appetite really waning. Well, you can see energy kind of doing its own thing. It initially was down with materials and financials, but holding up much better. Again, kind of they've been correlated with IWM, but today doing its own thing with what's going on with Russia, as it's really rallied up 2.25%. Energy has, and then you can see the XLK is down, XLY is down, real estate's down, everything is down to some degree. Staples and utilities not down as much, right, as they're outperforming over the past couple of days of risk offness in this area. And if I were to take a look at the 12 grid for these same sectors, you can see, rolling over, everything rolling over except for energy, which is on a nice good trend, but materials and just reminder about how much longer that trend can last. I mean, yes, energy on an absolute basis is back to $70, and that's we hit about 75, 72.5 in 2014, but on a relative basis, we're nowhere near. We're just barely getting started on some bullish relative strength and bullish this bullish line here. So when you look at it over on this chart and you compare it to SPY. I don't need to do that there. If you could look over here, again, this is on the weekly chart. XLE is just getting above the 200-week moving average of this. And to kind of put that in perspective, to show you just how much room that XLE has to outperform, that's how far down it is, right? So from that 2014 high point, right, where we on an absolute basis, we're there right now. But on a relative basis, we're nowhere near it. And we're just starting to change the trend. The look at the PPO isn't even close to being positive yet, and the MACD is kind of working its way higher. You've got a good RSI, so you've got basically a good thrust going on right now. The ADX is just below 20, so in other words, we're kind of just starting this long-term trend of outperformance potentially in XLE over the next little bit, and a lot of that's because of the dollar having been so strong. You would expect that it could temporarily be bullish on this news, but if it impacts this kind of recession expectations or bear market expectations, then you obviously it's been the risk appetite trade here lately, and the euro's been the safe haven trade. So you would expect after this temporary geopolitical mess, you would expect it to be temporary. That if it ends up turning into just more of a risk appetite or economic uncertainty, then the dollar would start to underperform from its high levels in that situation, because it had been linked to risk appetite over the past year or so. I also wanted to show this trend with the markets being down. You start to look for a spike in the trend to signal that we are at a bottom, right? To get that move, we started to get one here but it only got up to 1.1. The average only got up to 1. We had been so low. It needs to get up to about 1.25 or higher to really signal that we are in a low point. If I were to go to a weekly chart and then go out to kind of see these last corrective modes, there's COVID. You can see we almost got up to 1.5. Fourth quarter of 2018, you can see there about 1.25 is where that peak hit. 2015-16, we got up over 1.5 on the trend, and in 2011, you can see we got up almost to 2 on that. So that kind of shows you that we really get these big spikes in the trend when we are at the low point. And so that would suggest, considering that we're down to 0.68, that we are not even anywhere near the low point right now. Same thing here. This chart tends to bottom, get well below 50% when you're at the low point. We are at 1, so we're still not below, and the moving average is not down there. So we still, we still have some room to run. If we are indeed in correction mode, none of these indicators that typically suggest that we are at the end of the correction mode are anywhere near telling us that we've hit the low point and started to bounce yet. When we get back up above these 50-day moving averages and rise up. And this, which makes this drop down. You're still below the 200, but you start to get above a bunch of 50 days. That's what makes this come down here. All right, well, let's take a look at our trade idea of the day. We'll take a look at Cisco. You can see, obviously a bearish market forecast chart. We're well below the moving average, 7%. We got a cluster here, though its market sentiment's just barely, still inside of bullish territory. So there's still kind of some bearishness, despite how bearish it's already been. Obviously, you had a little bit of a flag pattern going on over the last couple of weeks, week and a half, and it appears to be we might be breaking out of that flag pattern. Let's take a look at the weekly charts, and you can kind of see an interesting pattern. Again, breaking the 200, the 40-week exponential moving average. Obviously, it has been below the 200-week. If you look at the two-line versions for Cisco, we had been up above this 8-day. We kind of been trying to hit that 200-day. Looks like we just nailed our head on it as resistance, and maybe, again, coming out of that flag pattern to the downside. This is what the weekly version of that chart looks like. And we are just starting to break the 50. So if we are just starting to break the 50, and we got some room down here to about 48.5, and the MACD is just getting negative. The stochastics is just crossing into bearish territory itself on the long-term chart. Its correction stage may be in infancy mode here. Maybe a little bit more than fetal, but in the infancy mode. If you just take a look at some of the other oscillating charts for this, from a DMI standpoint, it's been in bearish trend. It's still easily in bearish trend, and it hasn't really got too extreme yet on the positive indicator. You look at its RSI and its CCI, and we are easily below 40, easily in bearish territory. Got below minus 200 today. Looking at its Ichimoku trend cloud, we are in a very strong bearish trend right now, well below the cloud, but the blue line's not below the cloud yet. So it kind of shows you again, where we're at in the stages. If you look at its Bollinger Band, we're in the outer half of the bandwidth again. In this case, the lowest quartile, as we push below the point of control towards the lower end and flirt with some of these lows that we've had here relatively recently over the past few months. So it looks like we have a bearish trade set up, though we don't have a whole lot of room to the downside for a trade. So what I decided to do here was to do a put vertical spread in March expiration. So buying the at-the-money put, selling the 52.5. You can see what that does. Going for about a normal 3/4 of a normal position size, because you do have earnings coming out this week. So not completely full or coming out soon. We don't have a full position size, but you get a pretty decent reward for the position that we're in here. And now it just has to get below 52.5, so it doesn't necessarily have to break down hard. It just got to get down. We're at 54. It has to get below 52.5 and then stay there, right? And so when you look at it from this perspective, again, the possibility of getting 48.5 is pretty darn easy, especially when you're looking at, again, breaking below the 200-day moving average. And if you get below 52.5, you're getting below that point of control. We're going to be in a trending mode. It's going to very easily stay down at that level. So you have a high probability trade set up, considering and the other thing too is we talked about price crosses, then the 8 and 17 crosses, then the 30, then the 50. Well, the 8 and 17 are about to cross not only the 200-day but also the point of control. and the 30 is just crossed below the 50, so kind of the intermediate death cross there. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Remember also you can subscribe to our website at marketscholars.com. Like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody. We'll cross our fingers for a good outcome overseas, internationally, and then we'll see how things respond next week in the stock market from there. So again, thanks. Have a great one, and we'll see you all next time.